You've probably heard about order blocks before, but few traders truly understand how to use them with precision. In this episode of the ComLucro channel, we're diving deeper, revealing how order blocks combined with market structure can give you simple yet high-quality trading setups that actually work in real market conditions. You'll learn exactly how to identify valid order blocks, how to align them with higher time frame structure, and how to execute low-risk entries with confidence. I'll also walk you through a complete step-by-step trading plan built entirely around the order block concept. The same logic used by smart money to anticipate major reversals and continuations. So stay focused and follow along as we break down the theory, the confirmation, and the execution process you can start applying right away to improve your trading results. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, let's begin with the basics. What exactly is an order block? Order blocks are essentially refined or optimized supply and demand areas. From basic price action theory, we know that the market always moves in a rhythm of impulsive and corrective waves, shaped by the collective behavior of market participants. We identify the starting point of an impulse as a demand zone. This happens because in that area, traders have previously entered long positions with a clear intention. When price returns to the same demand zone, there is a higher probability that those traders, or new ones recognizing the opportunity, will start buying again. Simply put, demand zones highlight areas where we expect buyers to step back into the market. Likewise, the beginning of a downward move is identified as a supply zone, where traders have previously taken short positions. When price revisits this zone, it often leads to renewed selling pressure. In other words, supply zones are areas where we expect sellers to become active once again. Now, order blocks are a special type of supply and demand zone, but they form when a large number of buyers or sellers enter the market at once, creating a visible imbalance in price. This imbalance between buying and selling pressure can often be identified through what we call fair value gaps. These gaps appear when price moves too quickly in one direction, leaving certain orders unfilled, and the market may later return to those areas to restore balance. We usually mark the candle that appears right before the gap as our order block zone, because that is where major trading decisions were likely made. When price comes back to this order block, we often see a strong reaction as institutional buyers or sellers re-enter the market. So in essence, order blocks are still supply and demand zones, but the key difference is that we focus specifically on areas where larger institutional orders were placed, revealing where the real smart money operates within the market. Now, how do we actually mark the order blocks? We take the entire candle that appears right before the fair value gap and mark it as our order block. The color of this candle doesn't matter at all. For example, in a bullish gap, it makes no difference whether the candle is green, red, or even a doji with a very small body. All of them can represent valid demand order blocks. Here's an important point to remember. Sometimes, the wick of a candle grabs liquidity just before the imbalance occurs. When that happens, we also include that wick as part of the order block zone. This marks the true beginning of the imbalance, and for safety, our stop loss should always be placed just below that wick to protect the trade. Order blocks can vary in size. Some are small, while others can be quite large. When the zone is narrow, it's wise to use a slightly wider stop loss below it, because even though order blocks represent strong supply and demand areas, price does not always reverse exactly from the box. We need to give the market a little space to breathe before expecting a reaction. On the other hand, when the order block is large, you can place your entry closer to the middle of the zone to get a better price, or switch to a lower time frame to look for confirmation and rejection signals before entering. Now, what makes an order block high quality and worth trading? The answer lies in its alignment with the overall market structure. In an uptrend, price forms a sequence of higher highs and higher lows. Each time price breaks structure to the upside, it confirms the continuation of the bullish trend. The bullish order blocks formed along the way have a higher probability of rejecting price back to the upside if the market pulls back into them. This uptrend continues until the market eventually breaks below a protected low. That event is called a change of character, and it signals a potential trend reversal. It shows that sellers have gained control and managed to push the price lower. The bearish order block responsible for that move becomes a strong opportunity to go short. From that point forward, if the trend begins forming lower lows and lower highs, the bearish order blocks that appear along the way also become reliable trading setups. Of course, the concept of market structure goes much deeper than this, but for now, this explanation gives you a clear and practical foundation for understanding how order blocks form, how to identify them, and how to use them effectively within your trading strategy. Now that we've explained order blocks and market structure, it's time to move on to the actual trading strategy. This strategy operates using 2 time frames, and we've simplified it into 5 clear steps. First, analyze the market structure on the higher time frame to determine the overall direction. Second, mark the key order blocks. Third, wait for price to pull back toward those zones. Fourth, look for a change of character on the lower time frame to confirm the reversal. And finally, execute your entry from the order blocks on that lower time frame. As mentioned earlier, this setup always relies on 2 different time frames. The higher one serves as your main chart for day trading analysis, and the lower one is used for confirmation, precise entries, and managing your active trades. It doesn't matter exactly which time frames you prefer to use. The important rule is that your entry time frame should be at least 2 times lower than your higher time frame. For example, many traders combine the 1-hour chart with the 15-minute chart, or the 4-hour with the 1-hour, depending on their trading style. The next important point is that this strategy can be applied to any market or asset class. It makes no difference whether you trade Forex, crypto, indices, or stocks, because price action principles remain consistent across all charts. Still, make sure to backtest thoroughly before trading with real money, so you can see how the strategy behaves under different market conditions. Now let's return to analyzing the market structure, which is the foundation of this plan. The very first step is to identify the market direction. Trading in alignment with the main trend almost always gives you a higher probability of success. To determine that direction, look for clear breaks of structure, changes of character, and recognizable reversal patterns on your chart. If you can't clearly see the direction on a specific time frame, it's better to skip that setup entirely. Trading when the market direction is uncertain only increases your risk. It's much safer and more effective to focus on instruments or pairs that show a clean, obvious trend. This allows for better decision-making and more consistent risk management. Next, we identify the fair value gaps and mark the order blocks, which serve as our main trading zones. At this stage, we can simply place a sell limit order at the order block and position our stop loss just above it. However, for a more conservative approach, it's often better to zoom into lower time frames once price reaches this area. That way, we can observe how the market reacts around the zone and confirm whether the trade setup is truly valid. We want to see a clear rejection from the order block to ensure that it is being respected. Even though this setup has a high probability, price does not always reverse perfectly from the box. The market can easily ignore an order block, so patience and confirmation are key. The next step is to wait for price to pull back into the order block zone, and then drop down to a lower time frame for closer analysis. Remember, never jump into the market before price actually reaches your zone. Many traders get trapped by entering too early, right before the market delivers the real move. Now, in the final step of this trading plan, we look for confirmation signals and execute the trade on the lower time frame. After price enters our zone, we need evidence that the short-term uptrend has ended and that the market is preparing to move lower. To identify this reversal, we look for a change of character. This occurs when price breaks below a recent swing low, confirming that the short-term uptrend is over and that momentum is now shifting downward, in alignment with the bearish direction from the higher time frame. Once this reversal is confirmed, we wait for the market to form new bearish order blocks on the lower time frame, and then take the trade. This is why the method is known as order block within order block. It's important to note that the lower time frame order block does not always need to be fully contained inside the higher time frame order block zone. After identifying the lower time frame order block, we place a sell limit at the start of that zone and set our stop loss just above it for protection. For trade management, we aim for multiple targets. The first target is usually a 1-to-2 risk-to-reward ratio. Once price reaches this level, we close half of the position and move the stop loss to break even. The next target is typically the first significant support or liquidity zone ahead of price on the higher time frame chart. Here's a quick recap for the bullish scenario. The same rules apply, but in reverse. We wait for price to reach our higher time frame order block. Then, we look for a change of character on the lower time frame, which occurs when price breaks above a swing high. This confirms that the short-term downtrend has ended and that buyers are now taking control of the market. Once this is confirmed, we look for new bullish order blocks forming on the lower time frame and place a buy limit order at the beginning of the zone, with the stop loss positioned just below it. Targets are managed in the exact same way as in the bearish setup, following a structured risk-to-reward approach. Now, before we move on to real chart examples, let's quickly review a few common scenarios and how to handle each one effectively. Scenario 1. A very small order block on the lower time frame. In this case, it's safer to use a slightly wider stop-loss area to protect your trade from normal price fluctuations. A stop that's too tight can easily be triggered by minor volatility, even if the setup is still valid. Scenario 2. A very large order block on the lower time frame. If we place our stop-loss below the entire zone, it might become too wide and weaken our risk-to-reward ratio. Instead, we can either define a smaller protective zone just below the main block, or place our entry closer to the middle of the zone. Both methods help maintain a balanced and efficient trade setup. Scenario 3. Multiple order block formations. We can trade each one as long as they provide a reasonable risk-to-reward opportunity. However, it's essential to manage risk carefully. Never risk more than 2% of your trading account on a single position, and avoid having more than 3 trades open simultaneously. This discipline keeps you capital protected, even during losing streaks. Finally, always remember this: the goal is not to win every single trade. Losing trades, missed setups, and small drawdowns are all normal parts of trading. What truly matters is maintaining consistency, managing risk wisely, and finishing the day with a positive overall result. Now, let's look at some real chart examples to see exactly how to apply this trading plan in practice. Here we have the euro-dollar on the 1-hour chart. The recent price action shows that the market had been in a clear long-term downtrend until it suddenly shifted direction by breaking above this protected low. That break of structure represents a change of character, signaling that demand has taken control and that a potential bullish reversal, or the beginning of a new uptrend may be underway. Since the higher time frame direction is now bullish, we're only interested in looking for buying opportunities. The next step is simple. Identify the fair value gaps and mark the order blocks. In this example, we can see two distinct fair value gaps, so we mark the candles that created those gaps as our order block zones. These areas become our key trading zones for potential entries. If the price pulls back into any of these zones, we'll then zoom into the lower time frames to look for confirmation signals before taking a trade. So let's see how this plays out. The price has just tapped into the first order block, so we switch to the 5-minute chart to search for an entry. On this lower time frame, we want to see clear signs of reversal, confirmation that the order block is being respected, before opening a long position. For confirmation, we look for a change of character on this lower time frame. This happens when price breaks above the swing highs that led to the previous downward move. Let's play the price forward. Here, we can see that price actually broke below the order block without showing a clear change of character. Although there was a brief reaction to the zone, it failed to confirm the reversal we were looking for, meaning there's no valid trade setup at this point. Now let's go back to the 1-hour chart. On this chart, we still have another unmitigated order block zone below. If the price moves down into this area, we'll once again switch to the lower time frame to look for a precise entry signal. Let's see how the price develops next. The price has now tapped into this order block, so we zoom into the 5-minute chart again. On the 5-minute chart, the market has already shown a clear change of character. Exactly the reversal signal we were waiting for. This tells us the short-term downtrend has ended, and we can now start looking for long setups with confidence. The next step is to wait for price to form bullish order blocks, and then use them as entry points. Here, the market creates its first bullish order block, so we open a long position. As price continues to push higher, another order block forms, but this time without invalidating the previous setup. We open a second long trade based on this new formation. This approach is important because the pullback to the very first order block doesn't always happen. Sometimes the market only returns to the second one before continuing higher. In the worst case scenario, the price could drop deeper and hit both stop losses. And that's why we always trade with reduced risk. Now, let's see what happens next. The price hits the stop loss of the second trade, but keeps moving higher, triggering the first one. A bit later, another order block appears. Once again, without closing the first trade, we take a new long position at this fresh order block zone. We continue repeating this process until the market reaches our target. In this example, the previous high on the higher time frame. This strategy has proven to be highly effective, but like any method, it must be back-tested thoroughly before you treat it with real capital. The truth is, even with a solid plan, you will still experience losing trades, and that's completely normal. Losing doesn't mean your analysis was wrong. The key is consistency. Write down your rules, follow them with discipline, and stick to your risk management plan at all times. If you do that, you'll build the confidence and long-term stability every professional trader needs to succeed. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.